What if I told you there are 5 penny stocks under $3 that smart money could be quietly accumulating right now, before the next breakout move? Most retail investors chase stocks after they run, but today, we're looking at low-cost plays that could still be early. These are small-cap companies operating in fast-growing sectors, from clean energy to tech infrastructure and emerging innovation markets. They're inexpensive, volatile, and definitely not risk-free, but they also offer serious upside potential if momentum builds. In this video, we'll break down what makes each of these under $3 stocks interesting, what catalysts could drive them higher, and the risks you absolutely need to understand before investing. You do not want to miss this. Let's start with the first stock under $3. Before I reveal the name, here's why it made the list. This company operates inside a fast-growing industry that's attracting serious attention from both retail traders and institutional investors. The sector itself is expanding due to rising global demand and long-term structural shifts. Now here's what stands out. The stock is trading under $3. Market cap is still relatively small, and trading volume has quietly started increasing. That combination can sometimes signal early positioning before a larger move. Recent updates show improving operational discipline. Costs are being managed more efficiently. Revenue trends are stabilizing, and management has hinted at strategic initiatives aimed at future expansion. But let's stay grounded. This is still a penny stock. Volatility is normal. Sharp pullbacks happen. Liquidity can dry up fast. These types of stocks require patience and proper position sizing. This isn't about hype. It's about opportunity with risk awareness. Now let's go deeper into what this company actually does. This business operates in a high-growth infrastructure segment tied to the global energy transition. As adoption increases across this sector, demand for supporting infrastructure becomes unavoidable. And that's the key. This company isn't selling hype. It's building physical infrastructure that large enterprises and governments rely on. It already has an established presence in multiple regions. Network expansion is ongoing. Strategic partnerships are quietly forming, and revenue, while not perfect, shows signs of long-term demand. But here's the reality. The company is still in growth mode. That means higher expenses. That means tighter margins. That means investors must be patient. Short-term volatility, very possible. Long-term structural opportunity, also possible. The stock being under $3 makes it psychologically attractive. But smart investors don't buy just because it's cheap. They buy because the business model has potential. Catalysts. The first stock under $3 is ChargePoint Holdings, ticker CHPT. This company operates one of the largest electric vehicle charging networks in North America and Europe. As EV adoption increases, charging infrastructure becomes essential, not optional. Here's why some investors are watching it at these levels. First, scale. The company already has an established network footprint. Second, long-term industry tailwinds. Governments continue pushing EV adoption policies. Third, recurring revenue potential through software, subscriptions and network services. Now let's talk risk. The company has faced financial pressure due to high operating costs and competitive market dynamics. Growth companies in infrastructure-heavy sectors often burn cash before reaching profitability. That's the danger. But here's the opportunity. If EV infrastructure investment accelerates and cost management improves, recovery potential from sub-$3 levels could create strong percentage gains. This isn't a guaranteed winner. It's a calculated higher-risk growth play. Now let's wrap this up properly. We already discussed ChargePoint Holdings as a speculative EV infrastructure play under $3. But here's another company in the same broader space that investors are watching closely. BLNK Charging Co. Ticker BLNK. Both operate in EV charging infrastructure. Both are growth-focused. Both have experienced heavy volatility, and both trade at levels that make percentage moves very meaningful. Here's the realistic outlook. If EV adoption continues accelerating and infrastructure spending increases, companies like these could benefit from renewed investor momentum. A strong quarterly report, strategic partnership, or policy catalyst could spark sharp upside moves. But let's stay disciplined. These companies are not consistently profitable yet. Cash burn, competition, and macroeconomic pressure remain real risks. Penny stocks and small-cap growth names can drop fast if sentiment turns negative. So what's the play? High risk, high volatility, potentially high reward. Position size wisely. Diversify. Don't chase hype. Alright, let's close this out strong. The two under $3 stocks we covered today are ChargePoint Holdings, CHPT, BLNK Charging Co., BLNK. Both operate in the EV charging infrastructure space. Both are positioned in a long-term growth industry, and both carry serious volatility. Here's the honest take. If EV adoption continues expanding globally and infrastructure investment accelerates, these companies could benefit from renewed momentum, a strong earnings surprise, improved margins, or strategic partnership could trigger sharp percentage moves from these low price levels. But remember this, neither company is fully stable or consistently profitable yet. Cash flow pressure, competition, and broader market sentiment can push these stocks down just as fast as they rise. This is not about hype, it's about calculated risk. If you're investing in small-cap penny stocks, position size matters, diversification matters, discipline matters, high risk, high reward, smart execution.